Ever feel like you're stuck between a rock and a hard place? You want those investments that'll pay you a nice income, right? But you don't want to miss out on the chance for some serious growth down the road.
Yeah, trying to find that perfect balance.
It's like, when you're at Costco on a Saturday afternoon
Oh, I know exactly what you mean.
and you're circling the parking lot.
Desperately searching.
Desperate, you need to be quick, you need to be smart.
You don't want to end up in the back 40.
Exactly. Pushing that overflowing cart across the entire lot. No, thank you.
Right.
Well, that's kind of how it feels sometimes with investing, right? Especially when we're talking about real estate investment trusts. REITs.
Right.
Finding those REITs that can give you, say, a 6 to 8% yield, but still have some real growth potential.
The best of both worlds.
Exactly. Now, I know what you're thinking. 6 to 8%. Sounds a little too good to be true.
It can be tempting to dismiss those kinds of numbers.
For sure. And in some cases, you'd be right. But the thing is, if you know where to look, if you focus on the right sectors and the right REITs,
Then it becomes a much more realistic possibility.
it absolutely does, especially when you consider the fact that a lot of folks are a bit hesitant about REITs right now, right?
Yeah, there's this whole narrative out there that REITs are dead money when interest rates are going up.
Right. Dead money. We've all heard it.
It's become kind of a common assumption.
But here's the thing. That assumption isn't always accurate. Sure, rising rates can make things a bit tougher for some REITs.
But not all.
Not at all. In fact, some REITs can actually do really well in this kind of environment. The key, like with so many things in investing, is to understand the nuances.
To dig a little deeper.
Exactly. To look under the hood and really figure out what's driving their business. And that's what we're going to do today. We're going to take a deep dive into some specific REITs that I think have the potential to deliver both income and growth, even with interest rates where they are. We've pulled together research from all sorts of places, analyst reports, company filings, industry publications.
It's important to get a well-rounded perspective.
Absolutely.
Yeah,
So, are you ready to dive in?
let's do it.
All right, let's kick things off with WP Carey, ticker symbol WPC, currently yielding around 7%. Now, WP Carey has historically been what you'd call a diversified REIT.
Meaning they owned a pretty wide range of property types.
Right. Industrial properties, offices, retail, the whole gamut. And for a long time, that diversification was seen as a real strength. It provided a buffer against downturns in any one particular sector.
You know, don't put all your eggs in one basket.
Exactly. Spread the risk. But, you know how market sentiment can be. Fickle. It changes. What's hot today might be lukewarm tomorrow.
Trends come and go.
And, well, that's kind of what happened with diversified REITs. They fell out of favor. Investors started preferring REITs that were more focused,
Yeah.
more specialized,
So this broad exposure that was once seen as a positive for WP Carey.
started to be viewed a little more cautiously.
Right.
And the shift in sentiment was especially true when it came to office properties. With so many people working from home, there were all these questions about the future of office space, right?
A lot of uncertainty swirling around that sector.
So in 2023, WP Carey made a big announcement. They were going to spin off their office properties into a separate entity. And the market's reaction, well, let's just say they weren't thrilled.
There was definitely some selling pressure.
Yeah. Investors didn't seem to like the move. Maybe they thought it added complexity. Maybe they just didn't want anything to do with offices. But here's the thing. I actually think this spinoff was a brilliant move for WP Carey. And it created a really interesting opportunity for investors who, well, maybe weren't so quick to hit the sell button.
It's all about perspective, right?
It is. Because by getting rid of those office properties, WP Carey essentially de-risked their core portfolio. What they're left with is a much more focused portfolio, heavily weighted towards industrial and retail properties.
And not just any industrial and retail. We're talking about properties with long-term triple net leases.
Ah, yes. Triple net leases. Always a good thing for a landlord. Now, for those who might not be familiar with the ins and outs of real estate lingo, can you break down what makes triple net leases so attractive?
Sure. Basically, with a triple net lease, the tenant is responsible for a lot more than just the rent. They also pay for the property taxes, the insurance, and the maintenance.
So WP Carey doesn't have to worry about all those expenses.
Exactly. It makes their income stream much more predictable and stable. And a big chunk of these leases are also tied to inflation.
Meaning the rent goes up as inflation goes up. Another nice little bonus for WP Carey.
A built-in hedge against rising prices.
So you've got a REIT with a de-risked portfolio, strong tenants on long-term leases, many of which adjust with inflation, and all this while offering a potential 7% yield. For an income investor, that's a pretty compelling picture, wouldn't you say?
It definitely ticks a lot of the boxes.
All right, let's move on to another REIT that I've got my eye on, Realty Income, ticker symbol O. This one is currently yielding around 6.1%. And what makes Realty Income so interesting is that they're known as the monthly dividend company.
As the name suggests, they pay out their dividends every single month.
Like clockwork. And they've been doing it for decades. They're kind of a legend in the REIT world.
A very well-respected name.
Now, Realty Income is primarily focused on retail properties, but we're not talking about fancy malls or anything like that.
No, their portfolio is much more focused on essential retail.
Right. We're talking about convenience stores, drugstores, dollar stores.
The kind of businesses that people rely on no matter what the economy is doing.
Exactly. They've got over 13,000 properties globally, tenants like Walgreens, Dollar General, 7-Eleven. And like W.P. Carey, they use a lot of those triple net leases. Now, Realty Income's stock has taken a bit of a hit lately, and that's largely due to this thing called duration risk.
Which basically means that investors are a bit wary of companies with long-term leases when interest rates are rising rapidly.
Because those leases are locked in at a lower rate. And sure, Realty Income's leases do have built-in rent increases.
But those increases are typically pretty small.
Yeah, like 2% or so per year. So when interest rates are shooting up, investors might see those long-term leases as a bit of a drag on returns.
They'd rather have the flexibility to reinvest at higher rates.
But here's the thing. Realty Income has been through this before. They've weathered plenty of interest rate cycles. And they have a few key things going for them. First, they have excellent access to the bond market.
Which is how they finance their acquisitions.
Right. So even though rates are higher, they can still raise money at reasonable rates.
And their balance sheet is very strong.
Very strong. Plus, their occupancy rates are incredibly high, like over 98%.
Which tells you their properties are in demand and their tenants are paying their rent.
Exactly. And then there's their dividend growth streak.
Over 25 years of consecutive annual dividend increases.
That's not easy to do. So is Realty Income going to double in price overnight? Probably not. But for someone looking for reliable, growing income,
A bit of inflation protection.
it's hard to beat. Okay, let's shift gears and talk about Global Medical REIT, or GMRE. They're currently yielding a rather impressive 8.3%. Now, what makes GMRE interesting is that they specialize in medical office buildings. So we're talking about places where you go for, say, a doctor's appointment, a physical therapy session, an MRI, that kind of thing.
As opposed to hospitals or inpatient facilities.
Right. And the reason I like the sector is that healthcare spending is pretty darn resilient. People are always going to need medical care, regardless of what the economy is doing.
It's a necessity, not a luxury.
Exactly. And the properties that GMRE owns are often mission critical for their tenants. Doctors can't just pack up and move their practice to a cheaper location on a whim.
They need those specialized facilities.
They do. And like with the other REITs we've talked about, GMR's leases often include built-in rent increases. Now, GMRE's stock did take a tumble during the interest rate hikes of 2022-2023, and that was largely due to concerns about their leverage.
Meaning they had a fair amount of debt relative to their assets?
Right. And when interest rates go up, the cost of servicing that debt goes up. So investors got a little spooked. But here's the thing. GMRE has been working hard to address those leverage concerns. They've been selling off some non-core assets, paying down debt, extending the maturities on their loans.
You're taking the right steps to shore up their balance sheet.
And their rent collection remains strong. So if you can look past that short-term volatility, I think GMRE could be a really compelling opportunity. High yield in a defensive sector with solid fundamentals sounds pretty good to me.
Especially if they can continue to improve their financial position.
Agreed. All right, let's venture into a little riskier territory. Broadmark Realty Capital, ticker symbol BRMK. They're also yielding around 8%. But full disclosure, this one is definitely more of a high-risk, high-reward play. You might even call it speculative.
If not for the faint of heart.
No, it's not. So Broadmark specializes in short-term, high-yield real estate loans. They're kind of like the REIT equivalent of a hard money lender. They provide financing for projects that traditional banks might shy away from.
Things like land development or construction projects.
Exactly. Where there's a lot of potential upside, but also a higher risk of things going wrong. Now, what makes Broadmark unique is that they operate with zero debt.
They fund their loans entirely with equity.
which is pretty unusual for a lender, and it gives them a couple of big advantages. First, they don't have to worry about interest rate hikes impacting their own borrowing costs.
They're not beholden to the whims of the bond market,
Right, and second, because their loans are typically very short-term.
like less than 12 months.
They can adjust their lending rates very quickly as interest rates change.
They're nimble.
They are. But there's a reason why Broadmark is considered high risk. They've had some issues with borrowers defaulting on their loans.
Which can obviously hurt their returns.
Big time. And there have been questions about their underwriting practices. But, and this is a big but, Broadmark has made some big changes recently. They brought in a new management teams, they've tightened up their lending standards, and they're focusing on higher quality borrowers. So it's possible that they're turning a corner.
If their loan performance improves, the market might start to view them more favorably.
And that could translate into some serious upside for investors who are willing to take on the risk. It's a gamble, no doubt, but the potential payoff could be significant.
It's a classic high-risk, high-reward scenario.
All right, let's move on to a REIT that's tapping into one of the biggest demographic trends out there, the aging of the population. I'm talking about LTC properties, ticker symbol LTC, yielding around 6.7%.
LTC invests in skilled nursing and assisted living facilities.
Essentially, they're providing housing and care for seniors. And we all know that the senior population is growing rapidly. The baby boomers are getting older.
By 2030, every single baby boomer will be over the age of 65.
That's a massive demographic shift, and it's going to create a huge demand for senior housing. Now, LTC did take a hit during the pandemic. Senior housing facilities were, understandably, very hard hit by COVID. But LTC has been working hard to recover.
They've been renegotiating leases with operators, acquiring newer properties, and focusing on facilities with strong management teams.
Right, they're adapting. And their occupancy rates are starting to climb back up.
Plus, they have a very well-covered dividend.
Meaning they're generating plenty of cash flow to support those dividend payments, and they have capital available to make more acquisitions.
So they're well-positioned to capitalize on that growing demand for senior housing.
Absolutely. All right, last but not least, let's talk about Armada Hoffler Properties, ticker symbol AHH, yielding around 6.5%.
Armada Hoffler is a bit different from the other REITs we've talked about. They're what's called a vertically integrated REIT.
Meaning they don't just own properties, they also develop and build them.
Right. They have their hands in every stage of the process.
And their portfolio is a mix of retail, office, and multifamily properties, primarily in the Mid-Atlantic and Southeast regions of the U.S. areas that are seeing good population growth.
And strong job markets.
Now, Armada Hoffler did cut their dividend back in 2020. When the pandemic hit, they decided to play it safe.
A prudent move in uncertain times.
For sure. But they've since reinstated their dividend and have even started to increase it.
A sign that their business is recovering nicely.
And their development pipeline is really exciting. They've got a lot of new projects in the works.
Which could drive significant growth in the years to come.
So while they might not have the longest dividend growth track record or the highest yield, I think Armada Hoffler has a lot of potential, especially for investors who are looking for a REIT that's a little more growth-oriented.
A bit more of a total return story.
Exactly. Now, before we wrap things up, I want to talk about a few key things to keep in mind when you're evaluating high-yield REITs. Because, there's always a reason why a REIT has a high yield. Sometimes it's a good reason, sometimes it's not. So you got to be careful.
It's all about understanding the risks involved.
Rule number 1, pay close attention to the balance sheet. Look at their debt levels. When are their loans coming due? What kind of interest rates are they paying? Because if they have a lot of debt coming due in a rising rate environment, that could put a squeeze on their earnings.
And potentially impact their ability to pay dividends.
Exactly. Rule number 2, don't get too hung up on the dividend payout ratio. It's important, sure, but what really matters is the sustainability of the dividend.
Is the company generating enough cash flow to comfortably cover those payouts?
Right. A low payout ratio doesn't mean much if their earnings are volatile or declining. Rule number 3, carefully evaluate the tenant mix. Who's renting their properties? Are those tenants financially healthy? Are their leases long-term? Because if a REIT has a lot of tenants that are struggling or going out of business, that's a big red flag.
It could lead to vacancies and lower rental income.
Not good. And finally, rule number 4, look for REITs that are operating in sectors with strong long-term tailwinds. We've talked about a few of these today. Industrial, data centers, senior housing, healthcare. These are sectors that are benefiting from powerful trends that aren't going away anytime soon.
Investing in those areas can help mitigate some of the risks associated with higher-yielding REITs.
So the takeaway here is that finding those sweet spot REITs with high yields and growth potential takes some work. You need to be willing to do your research, to look beyond the headline numbers, and to understand the risks involved. But the rewards can be well worth it.
A little bit of effort can go a long way in this space.
It definitely can. All right, that's all the time we have for today. But before we go, I want to leave you with a thought. We've talked about a lot of powerful trends today: the rise of e-commerce, the growth of the senior population, the increasing demand for healthcare. Which of these trends do you think will have the biggest impact on the REIT market in the years to come? And how will that shape your investment decisions? It's a question worth pondering. Until next time, happy investing.